And I am particularly excited about this because it's great for the United States, but also could be modeled in other countries. Okay, so keep that in mind as we go through this. A lot of this might not be on your exam, but could be critical to your future and your success in doing the CEM type projects. So our objectives are basically really simple. We're going to focus on how to get 2 specific tax benefits in the United States. Now, I'm not just going to say it's out there and it's easy. I'm going to show you it's actually how to do it, like step by step. It's actually going to be quite easy, and we're going to go through 2 particular ones. One is about renewable tax credits, and one is about the 179D, which is all about energy efficiency tax deductions. Now, both are tax benefits, and they both were expanded in the Inflation Reduction Act. So I think it's a great opportunity for you to understand this. Now, in other countries, of course, you can talk about other local topics, local opportunities that are more relevant to you. So let's jump into it. Okay. Now, kind of a couple disclaimers. Number one, I'm going to say this, it's the last bullet, but consult a CPA. You're hearing from a PhD. I don't have a tax, I'm not giving tax advice. I'm just talking, okay? This is not the AEE official tax good guidance. Get your own tax advice, but I think you'll find this very helpful. And of course, this is available in the PowerPoint you're watching, the video you're watching and you're receiving. But if you want it to read it, if that's more your game, it's also published in the December version of 2023 for the International Journal on Energy Management. So you can read that or share that with people if you want, if that's more your game. And this presentation basically was also part of the annual update course, which if you're a CEM and you've taken that, you'd get this plus the AI discussions, which are pretty hot right now, and then a whole bunch of other technical updates on the CEM program. So that might be useful to you as well. So jumping right into our content, we're going to start with the renewable stuff. And for literally decades, you've been able to get 30% tax credit if you did renewable systems. That could be solar, it could be other types of systems. What is great and also bad is they extended that for 10 more years. This was supposed to trail off in 2023, and the same kind of slope here, trailing down on credits. But they extended it for 10 more years. So basically you have till 2033 before this starts, degrading. And that's kind of bad because that took away the sense of urgency to get things done. I can tell you that I installed projects on my commercial roof because the tax credits were going to be less. So, the urgency's gone. The good news is you have more time to do this. And I really hope you do, because I found that on my other investments, partly because the rates went up from the utility, I'm now getting 15% per year in return. And that's pretty much guaranteed for 25 years. So I'm pretty happy with it. It's a great investment. So I hope you can look into this as an opportunity. So big change with this year is they extended 10 years. You got more time. But they also did some very critical things, which are called bonuses. You can get beyond 30%. And this is where it gets very interesting. So the project we just did last year, we're able to get 50% tax credit. That's like getting it on sale at 50% off, okay? So if you paid 100,000, you really only would spend 50 after taxes, and that makes a dramatic change in your return investment. I'm going to do this very conservatively. We're going to walk through the different types of bonuses in tax credits that you can get. And I'm sorry for the imagery, it's a little fuzzy. You'll have a few different ways to get this information. But one of the ways, okay, so first let me say this is for under 5 megawatts, which a lot of projects are. If you're over 5 megawatts, you've got to kind of work hard to get even the 30%. You have to prove you have prevailing wages and apprenticeship hours, and you get 6% automatically, and then you have to earn the other 25%. And let me say that proving your prevailing wages and apprenticeship might not be as easy as it sounds, because you have to document that. And if you're hiring a contractor, then they have to show you their books to show you what they're paying those people that are working for them. And they might not want to do that. So be advised that that can be a little bit of a hiccup. But for most of you, you're probably doing projects under 5 million, and this could be for a house or a business. And let's just talk through the low-income community. So if you're in a low-income community, I'm going to show you on a map in a couple seconds where those are, so you know if you can get the credit or not, because your accountant will not know. You will have to tell them, and I'm going to show you how easy this is, okay? So if there's a bunch of criteria, whether if it's on Native American land, or if you're in a low income area, where I happen to live is one of those areas, or if you're in a low income community project. You know, lots of different ways you can earn that 10% credit, and actually could be up to 20%. Now, some of these are mutually exclusive, but I'm going to tell you, it's not hard to get to 50, okay? The low income community is that. An energy community means that your community was part of a fossil fuel. Fossil fuels played some part of the economy 10 or 20 years ago. And there's specific dates, but this map will tell you where those communities are also. So I'm going to show you this map, and you're going to see whether you're in an energy community or you're not. So if you are, you get 10% more, okay? And that's worth a lot of money. And it's some unlimited on the top end, by the way. I mean, of course, you know, you could do as many of these as you want under 5 megs, but you know, you're not limited that way. So, you know, 10% is 10% of what the project costs. Domestic content, I'll be honest, a little harder to get. My panels were made, some were made in China and some are made in Cambodia. It's just the way it is. A lot of that supply chain comes from over there. If your panels are manufactured in the United States, and including components and all that, a certain percentage of it is United States made, you can get an extra 10%. So a little harder to get, but definitely an opportunity. So think about all this. You can get from 30 to 50 pretty easily. And here's why I'm saying it is easy, okay? Here's the map I've been talking about. It's right off the Department of Energy website. You can find it on the IRS website as well, but this is probably the prettiest I found. And if you look at the world, okay, this is just United States, but you could use this as a model. If you're in Alaska, fantastic, good for you. I'm going to tell you what the colors mean here. If you're purple, that means you've qualified for the energy and the low income community, meaning you're going to get 20%, okay, extra tax credit. So you get 30% regular plus 20 bonus is 50% total. If you're in a peachy or yellowish area, you might not satisfy some of the criteria, but you might satisfy other criteria. So you could be at 10% or possibly get to 20 on the bonus, but I'll leave that to you to look at in the details of where you are. But as we zoom in the United States, you can see, and I would just conservatively guess, not even counting Alaska, that, you know, 30% of the United States is covered. And if you look at the areas that aren't covered, you know, a lot of that isn't incredibly populated. Nothing against my friends in the Midwest. I did live in Oklahoma for a while. So I just will say, I mean, if you're in Texas, you got a pretty good chance. If you're in any of the areas of Appalachia, you've got a pretty good chance. Even Nevada, you've got a pretty good chance. And so you just got to kind of zoom in and see if these credits apply to you. Now, do you think you can do that? Of course you can. You're a CEM, and if you're going to take the test, that's a lot harder than looking at a map. So give me a thumbs up if you're following along. Hopefully you are. Again, this is a recording, so it's a little redundant, but let's do an example for a small business or a home. Say your project costs 70K, okay? And that project's gonna save 4K. I'm giving you real numbers because this is my house, okay? These are the numbers from my house. Now, I will say I spent 70K, that's on the panels, and probably another 40K or so on batteries, which also got tax credits, but you don't need the batteries. That's kind of more of a peace of mind thing, okay? You might let's just look at the economics from the panels perspective and using the grid as your battery, which is the most common type of solar retrofit or solar projects you've got going on. So 70K, 40K, that's not too awesome on a return on investment. But again, you've had that 30% tax credit you could have gotten, you know, for the last few decades. So that really chops off a lot of the 70K. Now, because you're where I live happens to be in a former coal community, even though I don't notice it all the time, but there is that. And also, and it could be a former natural gas community. It could be any kind of fossil fuel. If it's an energy community, you have that opportunity. So 10% extra there and 10% on the low income, low employment area. Whatever reason people around here don't want to work. Anyway, jokes aside, those are statistics you can get off the IRS website and the DOE website, or just look at the map, okay? Simple. So right there, 20 extra percent tacked onto the 30 is 50%. So my credit is worth really 50% of 70K, which is, you know, 35K. So I only spent 35K on this portion. The payback was about 8 years at 9 years round up, or roughly about 11.5%. And that's if the rates stay exactly the same as they are now, and they are likely not. Even in where I've lived the last 10 years, the prices have gone up at least 20%, and there's all these taxes and environmental fees. Let me say this also, just side comment. you're already paying for the rebates because your utility takes a little bit off and puts it in these rebate pools. You might as well do the work and collect the revenue. Now that could be a sense of urgency because you're kind of spending for it in another bucket, and this is an opportunity to recover it. But we've probably already talked about that in the CEM program. So let's take a look at a little more details on this map. Now I live well outside of Louisville. I live in a purple area way over there. But again, all you got to do is zoom in and see where you're at. If you're in here, you're not going to get the extra 20% bonus. If you're over here, you might get some, 10. If you're in purple, you're going to get 20. Okay, so very simple to do. I hope you take advantage of that for the renewables. Now, on to what I would say is a little more complicated, but very applicable to CEM people. So the 179D. This is about energy efficiency. And formerly, the deduction used to be $1.80 per square foot. Okay, now that's pretty awesome. I have some clients have 10 million square feet, so that's $18 million in potential tax deductions. Now, deduction's not worth as much as a credit. That's worth about, 18 million would only be worth about 6 million in cash once you convert it back at, say, 30% tax credit or tax rate. But nonetheless, it's pretty impressive, and it's not asset-based. It's based on square footage, so it gives you a lot of flexibility. The exciting thing, and I really want you to pay attention because this is super exciting, is that for 2023 plus after the IRA, that's now up to $5 a square foot. That's a pretty big change, 1.8 to 5. Okay, that gives you tremendous, just a lot more opportunity. Now, here's the catch. I hate the way accountants talk sometimes. Sorry if I'm talking to accountants, but they use this word bonus depreciation. It's not really a bonus. It's accelerated depreciation, okay? You're able to move the money to a more close to where you are now in time instead of having it depreciate out in the future. Most accountants would be like this. Hey, you just bought some solar panels or lights or HVAC or whatever, anything that's kind of attached to the building. They're going to depreciate that over 27.5 years or some long cycle that's in their accounting books, according to MAKERS, which is the Modified Accelerated Cost Recovery System. Probably too much information. What this law does is it allows you to not depreciate that out over 25 years or 27 years, but able to move it back into time zero, like next year, this year, right now, immediate. And that has value because if you look at the graphics here, if you didn't have 179D, you got these credits and benefits that are happening way out in the future, and it might be beyond your company's planning horizon, especially if they have a 3-year payback. They're not going to count those benefits because they're way out in the future beyond 3 years. But with 179D, if you look at the animation, you get all those benefits now. So it does add value, even though they've labeled it as bonus. It's really accelerated depreciation, okay? Another catch is you can only depreciate up to what was spent. So even though you might have $18 million in tax deductions, if you only spend, $3 million on the project, you can only deduct $3 million. So that's the two things I want to point out to you, but still lots of opportunity here. And we're going to go through some examples on how to do this. There's a few more details I've got to cover with you here. You can get these things, these graphics off of legal websites, the IRS, et cetera. And I just pulled and have referenced where I've gotten these. But this just kind of spells it out. How do you get that 50%? How do you get $5 a square foot? It's a sliding scale. And the minimum is 25% savings from your projects on the whole building. So it's not just about lights anymore. You have to kind of make some pretty good savings. But I'll tell you, in a lot of the purple area, those areas have had cheap energy for a long time. And so the motivation to do energy projects has been relatively low. And guess what? I can go out in my community and still find T8 and T12 lights because they haven't cared. And now you can give them this chance to care, spend a little money and save more than 50% on the building and get this awesome tax deduction, okay? So I think there's a real opportunity there. I would be personally disappointed if I don't see $500 million in projects get done because of this legislation, hopefully because of this video showing you how to do it, but maybe I'm just optimistic. Anyway, a couple of other caveats. Got to be at 25%. Anywhere between 25 and 50%, you have this sliding scale, okay? It's basically $1 per 10% on square foot savings. So I'll go through that. A couple of other things. It's a deduction for energy efficiency. You can't get this one for renewables. They can significantly impact, and it has to be the whole building. And you've got to keep the records showing that this actually happened, right? And that's not too hard. You can do a amp draw on a light before and it's installed, an old light, and then an amp draw on the new light. That's easy, that's documentation. You have to document the prevailing wages. But if you're paying your people fairly, that shouldn't be that big of a deal, okay? That's not going to be very hard to do to justify this. And the apprenticeship hours, this encourages you to hire people, young people, much the way we're training younger CEMs these days. It's helping the world. You're helping train a workforce become good at what they do, and that's worth something. So keep in mind of these two little requirements. They're not hard to meet. And let's get into an example on this. And there's another slide here. If you don't like the way I teach, you could read this other slide and find it's said a different way, kind of easy. This has a few more words on the prevailing wage. I will say something that's a little bit not intuitive is sometimes the apprenticeship requirements, might be 12.5% in the 179D, and I think it's 15% in the renewables. Not a big deal, but just be aware of those small details, okay? And again, you have to maintain the records. Just get all through these little caveats, but they're not hard. You've got the slides, you know what to do. Here's an example on the results of this. Now, if it's post 2023 and after, then you can get up to 5 million a square foot. Let's be conservative when we say we got a project that does lighting, HVAC, and envelope, and who knows, maybe some other things, and it's going to save money, great. And you spend 3 million, the client, private building, tax-paying entity pays 3 million bucks, okay? The project saves 40%, maybe not 50, but you get to 40% savings. You document that, fantastic, pat yourself on the back, that's great. You get $4 a square foot in accelerated depreciation. So at 800,000 square foot facility, the tax deduction is worth about $3.2 million. Again, because you only spent 3 million, you can only claim 3 million in deduction. But still, you should be okay with that. You're going to move that all to time zero. That's going to help the company's cash flow by avoiding their taxes now. You might think of this several different ways, and you present it several different ways. You can say, hey, $3 million you make next year, the first 3 million you make is tax-free. That appeals to some CEOs and CFOs. You can pitch it a lot of different ways, but that's just one way that I found to be very, very effective. You're getting the benefits now versus in the future. Now, there's other things you can do that are kind of exciting. In the last few years, you can actually attack, and I say that word generously, you can help non-taxable entities. Okay, so let me walk you through this. If you're the architect, contractor, dare I say the word energy consultant because it's in the language, you can help them because they're not going to get these tax deductions. They're not going to get tax credits or deductions because they don't pay taxes. But through this special rule, the 179D or the renewables, you can help non-taxable entities, okay? The word in the language is designer, okay? So if you're the designer, again, architect, consultant, contractor, you play a role in that. You can help pass through the credits, use your company to buy the stuff, you pass through you get the credits and you pass some of that on to your client. Maybe all of it, maybe 50%, it's up to you. One caveat on this, only one contractor or energy consultant or designer can claim it. So if you're first to the party and you get language on, hey, I own this, these credits in the future, then that's a good document to have. It can be a one-page memorandum of understanding. So let's take a look at a government example. Again, before 2023, the credits are only $1.80 per square foot. And, you run the numbers, you spend 3 million, you get 800,000 square foot building. So your tax deduction is worth 1.4 million. Assuming 30% tax credit, then the cash value to the designer, which you might pass on to your client, some of it is 432 bucks. So you get 432K, okay. Let's say you split it with your client, say they're the city, and you split it 50-50, you're going to give the city 216K, okay, which they never would have gotten before. And I would say this is a pretty good value proposition. You walk up to any city, any county, Red Cross, any government, non-government building, or government building or non-tax-paying entity, and you walk in and say, I'm going to look at your stuff, I'm going to find projects for you, I'm not going to charge you, I just want the tax credits. And at the end, there may be some split of these tax credits, which I will give you. You're not really imposing on them anything. I mean, you're not charging them fees up front. You can run a business model off this. I can tell you it works very well, and it's very non-threatening. And you need to remember the sense of urgency. Who knows how long the tax credits can be around? Get your client to commit to that, and you can help their projects quite a bit. So like I said, I think this is an incredible opportunity, especially when you consider 2023 plus, and that went from 1.8 benefit, $1.8 per square foot, maybe again, we'll just say up to 4. You could maybe be 5 if you're really, really good, but let's just say you did $4 a square foot. On the 800,000 square foot, sample case study here, your net deductions, your tax deductions were 3.2 million. So, you can only claim 3 million because you spent 3 million, but who cares? You basically accelerated all of the depreciation benefits to right now, and $3 million at the 30% tax credit means the cash value to the taxable entity is $1 million. So the contractor, they're going to get $1 million in, benefit. And then let's just say they split it 50-50. Again, now you're giving $500,000 to your city. They like you. And if you're an energy manager, energy engineer, or people on this call typically, it's nice to be liked once in a while. This is a way you can come in there and, help them and give them a nice cash gift at the end. Maybe the cash pays for your time, however you want to work that out, totally up to you. But also, whenever you donate that $500,000, I will say, guess what's going to happen on your taxes next year? You just made a donation for $500,000. So you can run this a lot of different ways, but I think it's pretty exciting for you. People will say, oh, this is more difficult than it is. Don't believe me? Ask ChatGPT. Okay, we covered this in the CEM update, and this is kind of a play on that. It's like to say, let's just see what ChatGPT says. And I can tell you, because I've looked at what the internet work I've done, what I've actually done with my clients. Here's the list. It's not hard, okay? Eligibility. You're going to make sure this project actually happens, and it is HVAC equipment. It cannot be process equipment. It can't be equipment like cooling for a specific process. My wife's clinic, we can't count the cooling mini splits that are for the sonograms because it's part of the process. But it's related to building, environmental air conditioning, lighting, just general building. It's 179D. CEMs are pretty good at seeing if that stuff is eligible. That's what we talk about in the entire CEM class. So you should have a pretty good idea what the equipment is. Simulation, you might need to have a friend do this for you. Or in some cases, if it's so blatant, like your energy per device or energy per square foot, energy intensity drops by 50% in the maximum case, you can, do the amp draw before, do the amp draw after. You will not need a simulation on that because it's pretty straightforward. And I can tell you this actually happens. My local community center here had a 400 watt metal halide surrounded by two 250 watt halogen lamps each that they had in their convention center. They use the halogens for dimming and the metal halide for their big, white bright light. Well, we switched that out to something that cumulatively is less than 300 watts with color changing and a lot better improvements aesthetically. So they went from roughly, let's just say 1,000, close to 1,900 change down to 300. Pretty sure that's more than 50% savings. So bam, done, but you might have to hire a friend to do this. Not a big deal. Go look in the AEE member directory and you could find people who do simulation. Okay. Certification. Now, this has to be done by a third party. Let me just tell you who the most qualified people to do certification in the world are. You, CEMs, because you have the knowledge. You can do the kind of math I just was walking through. You are the people and you can make this happen. So make it happen, all right? If you need, if you're doing the project yourself, hire a friend, another CEM to do the certification for you. Not a big deal. This is easy. Allocation letter. And since I already talked about pass-through entity, we'll skip that because you can look that up if you need more time on that. But basically, that's where you're helping a non-taxable entity. You can run the tax credits or benefits through you. Let's talk about the allocation letter. What does that look like? Well, here's a sample. This is one I did with my county back in 2018. And it documents a couple things. You got to say, who you are and where this facility is, how much they spent, when it was installed, and then for your accountant. Their accountant's going to need this one-page piece of paper that the county signed off on it, or whatever your non-taxable entity is. And then you're going to document all the different spaces and what was done. And this is kind of a blow up here, a little closer, a little clearer view. What was done, what the affected square foot for each of those spaces were, what systems. It's a little simpler now because you're not dealing with the 1.8 square foot, $1.8 per square foot. You're dealing with up to 5. So you can do it a little bit different, showing, hey, before and after energy, consumption. And anyway, you're going to get, in this case, this is one client, 275K in tax deduction that went to me. And then I shared some of that back with the client. So this can help you personally, this can help your business, that can help your client. This is kind of a three-way win. And I just want to just tell you, this is not hard, right? You have to show the prevailing wages were applied. You have to do a little documentation. You probably are doing that anyway in your energy performance reports. The apprenticeship hours, you might have to work a little bit with your contractors to get that, but hey, I mean, make it contingent, and you can write the contract in advance saying, we're going to do this, and assuming we're going to get the savings we expect, then, you know, contractors, you have to do these things if you want this job. You can make that part of the condition. So you can kind of set it up, you know, that it's all dependent on everyone doing their part. But as a CEM, you're the best people in the world to do this, and you are definitely qualified to be the certifier. So don't question yourself, just go out there and do it. And hopefully this section provides you some guidance on how to do it and how to look up the maps and things like that. I really hope that it benefits you. I can tell you beyond this, and just a little extra side tip, this is not going to be on your test, I'm pretty sure, because I've written about this for years in buildings and other places. You know, you can actually get some pretty good significant benefits out of this. And I just want to run the scenario. What happens? Because I'm hoping it happens to you, that you do such a great job with this, that you generate so many tax deductions that it exceeds your annual revenue. So if you're, you know, let's say you're doing extremely well and you're making $1 million a year, and you found tax credits for $1 million, your tax base is zero. I mean, you pay zero taxes that year. How many of you think that's great? Okay, would like that. Good for you. Okay, so what happens though if you generate so many tax deductions that it exceeds your revenue? So say you make, you found $500,000 and 179D deductions, but you only made 300K last year. Well, let me just say this, and I had to share this idea with my accountant because it's not intuitive to them. They don't think this way. But if you made 200K more than you needed, then what you can do is take your 401K, move 200K from the 401K into the Roth, or it could be an IRA, doesn't matter. Move it to the Roth type accounts, claim the income for that year, and guess what? Now you move 200K and you have 200K tax deduction, zero tax, done. And you just moved 200K into the safe zone. I did this one year and actually moved, I can't remember the number, but I went ahead and went beyond this and said, well, I'm married, so the income threshold to pay taxes was 70K, whatever year that was. And so whatever the number I moved into the Roth, I added 70K more because I could move all that money and still not pay taxes, or 69,999, whatever. You know, so hopefully this helps you. If I went through that kind of fast, if you need to replay, you can, but hopefully this helps you, you know, again, get lots of projects, help lots of companies, help lots of non-tax paying entities, and help yourself. And that's why we wanted to put this in the section 1.9. 1.8 is now in part of the CEM. Again, kind of an optional extra value section. If you want to learn more about this stuff, you can go look online. There's tons of resources. This is from the Climate Reality Project, which is a good place to look. They've done a nice job of documenting all the ways you can, you know, get rebates or benefits from doing electric vehicles or other things you might do. And utilities also may have rebates in your area that can significantly help projects that we wanted to make you aware of. But the primary goal of this was, you know, to understand in this section for the United States, folks, you know, what is the renewable credits? How do you get them? How do you get these bonuses? Look at the maps. And then for the 179D stuff, you know, how to understand that and how to achieve that. And hopefully this is helpful. And again, in other countries, you can use this as a model. This might help you, you know, do wonderful things in your countries, and I hope it does. In your other countries in the CEM, maybe you guys talk about local opportunities that are better than this. Who knows? But I hope you've enjoyed this. I've enjoyed teaching it, and